Hello everyone, this is Jennifer. So in this video we're going to look into the cash flow statement. So cash flow statement is basically classified. The cash flow activities are basically classified into three kinds, that is cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities. Cash flow from operating activities. Operating activities basically are the main revenue producing activities of the company. They include the sales, the royalties received, other revenues which are directly relating to the operations of the company. So these involve producing goods and services and selling them. Cash flow from operating activities generally result from the transaction and events that enter into the determination of net profit or loss, that basically impacts your net profit or loss. Okay, so those transactions are basically considered to be your operating activity transaction. So the operating activity transaction, when there's cash inflow and there's cash outflow, there are two kinds, cash inflows and cash outflows. When the cash comes into the business, it is known as cash inflow. When the cash moves out of the business, it is known as cash outflows. So what are the examples of cash flow from operating activities, the cash inflows? The first one is cash sales. When you do a sales, you receive cash, so there's a cash inflow into the business. Cash received from debtors for sale of goods or rendering services. So you sell your goods on credit, then you receive it from your debtors at a later stage. So that is also an inflow of cash. Cash received from royalties, fees, commission, and other revenues. So what are the cash outflows? Cash purchases, when you purchase something, okay, which is used for your manufacturing process. At that time the cash is moving out and the material is coming into the business, so that becomes a cash outflow under the operating activities. Cash payments to suppliers of goods and services, then payments for operating expenses, example your wages, salaries, rent, insurance, which are directly linked into your manufacturing activities, which are used for your sale of goods. Okay, cash payment to government for taxes and duties. So these all are part of the operating activities. Now moving on to your investing activities. Investing activities basically include purchase and sale of fixed assets, securities, etc. Cash flow from investing activity discloses expenditure incurred for resources intended to generate future income and cash flows. So basically this activity is concerned with your fixed assets, securities, or your long term borrowings, which are basically used to generate cash flow in the future. Okay, examples of cash inflows of investing activities are cash received from sale of fixed assets and intangible asset, cash received from sale of securities such as shares, debentures, etc. So when you basically sell your shares, you receive cash payments, right? So that is also, or you receive the capital in the form of capital. When you sell your shares, you receive your capital, so that is also receive, cash received. Then receipt of interest and dividend on investment. Basically when you invest in another company, you buy the shares of another company, at that time you will receive the interest and dividend of that particular shares or debenture, so that becomes a receipt of interest and dividend on investment. What are the cash and outflows under investing activities are cash payment for purchase of fixed assets and intangible asset, cash payment for purchase of securities, and loan given to borrowers. So next activities is your financing activities. So cash flow from financing activities. Financing activities are those activities which results in change in size and composition of owner's capital or shareholders fund and borrowing of the enterprise. So basically which results from uh, the changes that you make in shareholders funds or borrowings. Okay, when you're raising extra capital or when you're raising borrowings from creditors or when you're raising borrowings through your debentures or long term borrowings, at that time also there's cash inflow and outflow that happens in a business. So those activities are considered to be the financing activities. So cash inflows from financing activities are cash proceeds from issue of shares, cash proceeds from issue of debentures, bond, etc., short term and long term loans or borrowings. Then the cash outflows are redemption, when you are supposed to redeem or repay your preference shares, your debentures, your loans, when you're supposed to pay your dividend, interest on debentures and loans. At all this time there's cash outflow in the business. So what is the procedure of preparation of cash flow statement, which is already explained in the PPT? So I will just look into the calculation of cash from operation or operating activities. So the cash from operation basically refers to the cash generated from the trading operations of the company. So in order to determine that, there are three methods basically. One is the cash sales method, second one is the adjustment of current account to fund from operation, the third one is the net profit method, which is under your accounting standard 3. So let's look into the first method, which is cash sales method. So format of computation of cash from operation under the cash sales method. So sales minus your increase in the account receivables, you get your cash sales. So in that you minus your purchases minus your increase accounts, and when you balance it with your cash paid in payable creditors and cash operating expenses, if anything is there, if you adjust it, you get your cash from operations. So let's look into this clearly with a example. From the following, calculate cash from operation. They have given total sales, total purchases, debtors at the beginning of the year, creditors for supplies at the beginning of the year, creditors for supplies at the end of the year, and operating expenses. So we'll start with cash sales. That's what they have told, right, as per the format. So we'll start with cash sales. So in order to find out the cash sales, they have given in the question the total sales, which is 6 lakhs, minus your increase in debtors. So increase in debtors, 2 lakhs is at the end, minus beginning of the year, which is 80,000. So you get 1,20,000 is your increase in debtors. So the cash sales will be 4,80,000 minus your cash purchases, if anything is there. So in order to find out cash purchases, we need to calculate our cash purchases. So in the question they have given total purchases, which is 4,50,000. So if you minus your increase in creditors, you can find out your cash sales. So increase in creditors, which is nothing but your credit sales. So at the end of the year is 1,20,000, at the beginning is 150,000. So 1,20,000 minus 50,000, which is 70,000. So the balance is 3,80,000. So the cash sales minus your cash purchases, you get the balance to be 1 lakh, less any operating expenses. We have in the question operating expenses given 80,000, which is paid in cash. So 1 lakh minus 80,000. So the cash from operations that we have is 20,000. So the basically the format talks about cash sales minus your cash purchases and minus any operating expenses that is being charged. The resultant figure will be cash from operations. So cash sales minus cash purchases minus operating expenses, you have got cash from operations. Moving on to our next method, which is adjustment of current account to fund from operations. Adjustment of current account to fund from operations. The format of computation of cash from operation is, you start with fund from operation, you add the decrease in current assets and increase in current liabilities, and you minus your increase in current assets and decrease in current liabilities. Then you get your cash from operations. So let's look into this example. So calculate cash from operation from figures given below. Okay, so they have given everything, they have given 2 years. So we're supposed to calculate cash from operation. So So you start with fund from operation, which is 10,000. So now what will we do is decrease in current asset and increase in current liability will be added. So decrease in current assets. So what are your current assets here? Inventories has increased, so you will not take it. Sundry debtors has increased, so you will not consider it. Bills receivable has decreased, so you will consider it. So bills receivable 52,000 minus 51,000, which is 1,000. Short term marketable securities is a current asset, it has decreased, so you consider it. Short term marketable securities 1,000. And prepaid expenses has decreased, so you'll consider prepaid expenses 1,000. So total is 3,000. An increase in current liabilities. Sundry creditors has increased. So 1,10,000 to 1,12,000. 12, so 2,000 is your increase. So total you get 5,000. Next we'll minus the decrease in current liability. So any current liability has decreased. Bills payable, last year it is 28,000, this year it is 24,000. So bills payable will be considered 4,000. Any increase in current assets. So if you see in the question, inventories has increased by 5,000 and sundry debtors has increased by 3,000. So total is 8,000. So the resultant figure is 12,000. So 15,000 minus 12,000, 3,000 is your cash from operation. So moving on to our next method, which is your net profit method. So under your net profit method, you will always start with net profit as per the income statement. You will add all your non-cash and non-operating expenses and you will minus all your non-cash and non-operating incomes. So I have explained already this in your PPT, so I will start with the problem. Following is the trading and profit and loss account for the year ended 31st March 2016. So they have given the trading profit and loss account and they have told us to calculate cash from operation. So the statement showing cash from operation, you will always start with net profit. So your net profit is 30,000. So you will add all your non-cash and non-operating expenses. Non-operating expenses are expenses which does not fall under your operation, and non-cash are basically which cannot be valued in the cash form, but there is decrease or increase value happening in the business. So your non-cash and non-operating expenses in the question, if you see, salaries, depreciation, loss on sale of investment, and goodwill written off. Rent, salaries, if you see, it does comes part of the operation activities. Rent also is a part of the operation activity. Depreciation is a non-operating or a non-cash expenses. Loss on sale of investment is a non-operating expenses. Goodwill written off is a non-cash expenses. So if you total it up, you get the amount to be depreciation 9,570, loss on sale of investment 3,200, goodwill written off is 3,940. Total it comes up to 16,710. So minus your non-cash and non-operating incomes. So if you see in the question, everything is operating in nature except profit on sale of building, which is a non-operating in nature. It does not form under the part of operations of the business, which is 25,000. So profit on sale of buildings 25,000, therefore the cash from operations is 21,750. Moving on to our next sum, which is, from the following details, prepare land and buildings account and explain the treatment of various items in the preparation of cash flow statement. Balance in land and buildings account as at 1 4 2014 5 lakh for 60,000, and as at 31 3 2015 is 8 lakh and 4,000. There's a purchase happened during the year which is 3 lakh, and there was no sale of any buildings or land during the year. So you're supposed to prepare a ledger account. So land and buildings account, by to balance brought down, it will have a debit balance which is 5 lakh 60,000, and by balance carried down, closing balance 8 lakh 4,000. And purchase of land and buildings during the year. So they have told there's a purchase. So when there's a purchase, cash is moving out. So it will be to cash account 3 lakhs. So it's considered to be purchases. And they have told there was no any sale of land and buildings during the year. So they have told clearly there is no sale, but here they have told it as buy cash and they've considered it to be sales. Actually, it should not be sales. Instead, it can be considered as by depreciation account, which is 56,000. But here they have considered to be sale. So you can basically erase this point and consider it as buy cash sales 56,000. So thank you everyone.